What if I told you that when thieves stole $100 million worth of French crown jewels from the Louvre, the museum didn't receive a single dollar in insurance money? The shocking truth about museum security might surprise you. In a shocking daylight robbery, thieves made off with over $100 million in French crown jewels from the Louvre. But what happened next surprised everyone. The museum didn't receive a massive insurance payout. Why? Because these priceless treasures, like many artifacts in major museums worldwide, weren't insured in the traditional sense. It's a deliberate financial strategy that seems counterintuitive at first glance. Major state-owned museums like the Louvre often self-insure, a sophisticated term for accepting the risk themselves rather than transferring it to an insurance company. Instead of paying millions in annual premiums, these institutions invest that money into world-class security systems, climate control technology, and detailed recovery plans for when the unthinkable happens. From an insurer's perspective, how do you calculate a premium for an irreplaceable 17th century diamond tiara? The value is astronomical, and while theft risk is statistically low, the consequences are catastrophic. For objects that rarely move, it makes more financial sense for governments, which own these national collections, to absorb the risk themselves rather than pay exorbitant premiums. This isn't just a French approach, it's a global strategy employed by museum titans worldwide. The UK government has its own indemnity scheme for artifacts on loan between institutions. In the United States, the federal government provides indemnity for international exhibitions, while large American museums often create their own captive insurance programs. When something is truly priceless, the goal isn't to receive a check if it's stolen. The goal is to get the item back. That's why recovery efforts are so intense following high-profile heists. The Louvre Heist follows a troubling pattern of daring museum thefts. Remember the Green Vault robbery in Dresden? Or the stolen Van Gogh from a Dutch museum? These incidents highlight the ongoing cat-and-mouse game of museum security. French police have made arrests in the Louvre case, a major breakthrough. But a critical question remains. Where are the jewels? Every day that passes makes recovery more difficult. Thieves often can't sell recognizable pieces on the black market. Instead, these treasures are frequently broken apart, their gems recut and metals melted down, destroyed forever and lost to history. For insurance professionals, the Louvre Heist serves as a real-world case study in extreme risk management, highlighting the limitations of commercial insurance for unique, high-value assets. As the investigation continues in Paris, the focus remains singular: recovering the jewels. The arrests offer hope, but the treasures remain missing, their display case in the Galerie d'Apollon sitting empty. Let's recap what we've learned about museum insurance. Major institutions like the Louvre often self-insure rather than paying enormous premiums for irreplaceable treasures. Instead of insurance policies, these museums invest in world-class security systems, climate control, and detailed recovery plans, a calculated financial strategy that makes sense for items that rarely move. This isn't just a French approach, it's standard practice for major museums worldwide, from the UK to the United States, where governments often provide indemnity, or museums create their own insurance programs. When priceless treasures are stolen, the focus isn't on insurance payouts, it's on recovery, because you can't write a check to replace history. Thank you for watching our deep dive into museum insurance and the Louvre Heist. If you found this information valuable, please like and subscribe for more insights into the fascinating world of risk management and cultural treasures.